Good afternoon, everyone. It is officially 12, so we're going to go ahead and get started with today's session on Social Security 101. I'd like to introduce our presenter for today, Ryan Hyslop. Ryan currently serves as managing partner and team lead at Sierra Pacific Wealth Management. Previously, Ryan served as senior vice president, senior portfolio manager, and team lead at Sierra Pacific Group at Morgan Stanley. Ryan started his career in the wealth management industry at Edward Jones, where he grew to be the largest producer in the country for his length of service. In 2020, Ryan was named to be the Forbes top 20 best in-state wealth advisors for Nevada. Ryan has over 11 years of industry experience and is a certified financial planner. He holds a Series 7 and a Series 66 license and all lines of insurance. Prior to the wealth management industry, Ryan spent 12 years as an active duty in the United States Navy, serving as naval aviator. He completed 2 combat tours, including USS Enterprise during Operation Enduring Freedom and aboard USS Harry Truman during Operation Iraqi Freedom. Ryan fully retired honorably from the United States Naval Reserves in 2017. He graduated from Trinity University in San Antonio, Texas, with a BS in Finance and Economics. He completed his graduate work at the Harvard Business School and is an active member of the HBS Alumni Association. Ryan lives in Incline Village with his wife, Carly, and their 2 youngest daughters, Raylan and Rowan. Please join me in welcoming our presenter, Ryan Hyslop.
Thank you, Vanya. I really appreciate it. Can everyone hear me? Somebody just give me a thumbs up in the chat or on your screen if you don't mind, so I make sure that I'm heard. Yes, can everyone hear me? Vanya, can you hear me? Someone in the chat just...
We can hear you just fine.
Okay, great. Okay, I got somebody said yes. Okay, great. Well, welcome everyone today to Social Security 101. What baby boomers need to know about their retirement income. Today, we're going to go over the basic facets of Social Security, get you comfortable with a couple of the most important topics within Social Security, and then we do a follow-up presentation in, I believe, in a week and a half, where we do a Social Security or advanced Social Security, where we go over. Okay, I have someone saying hard to hear. Can everyone else hear me okay? Might be your computer there, Susan?
Yes, we're hearing you fine. So it might just be that individual computer.
Okay, great. Okay, good. I'm actually coming to you today from Cardiff by the Sea here in North County. As you can see behind me, socked in the fog here on the coast for the day. Hopefully we'll see some sunshine later. So this is an interactive presentation to go over the basic facets and some definitions within Social Security. Talk a little bit about the COLA, or the upcoming cost of living adjustment that should be announced here in about a week by the Social Security trustees. We'll talk about the efficacy of the Social Security Trust Fund in the program. We'll also talk about some basic terms that you need to know when considering or thinking about Social Security in the context of your overall retirement and your retirement strategy. I believe that this presentation is particularly pertinent and important to understand at this point in the markets, with where we are here, fully entrenched in a bull market, or excuse me, bear market, hitting a nadir 2 days ago of 25% down in the S&P 500 since January 1. We're getting a little bear market rally here, but we'll probably retest those lows, if not go lower. Would be my prediction here in the month of October, if not November, before we start to get some type of movement from the Fed and lower inflationary numbers and some type of pivot for the Fed, either slowing down interest rate hikes and or reversing course and beginning to start easing. So that's generally where I see markets going. If you have more interest in that, you can always join our investment interest group on the 4th Tuesday of the month. This is going to be more of a focus on Social Security and why it is an income stream, A, that you can't outlive, B, inflation protected, and C, and most importantly, is guaranteed by the full faith and credit of the United States government and should be thought of as a very important part of your Social Security, or excuse me, your entire retirement package. Bonnie, if we'll go ahead and go to the next slide. All right, so people are hurting their retirements by making really bad, costly decisions around Social Security. I see this all the time. I've lectured on Social Security now for the better part of a decade, if not longer. not only to individuals such as all yourselves, but also to other professionals in the industry, other financial advisors, CPAs, attorneys. And it has always surprised me the amount of misinformation, or if you want to call it disinformation, misinformation, or the general lack of understanding out there about the Social Security system and how it works. Next slide. So here are the important things we're going to talk about today. You have several claiming options. The decisions have far-reaching consequences. The choice impacts both spouses. Very important to consider if you're married or you have a partner. The system is not bankrupt, nor is it a Ponzi scheme. We'll talk about the actual trust fund and how it works. Benefits are likely help to family member, and then just remember your friends are not experts. It does take a long time to understand and learn the Social Security system, and I'm here to help unravel some of it today. Next slide. So what do you want to know? We're going to actually discuss the top three here today, and then when I do advanced Social Security in a week and a half or so, we'll go over the last two. But will Social Security be there for me in retirement? The simple answer for most of you is yes, absolutely. It will be in exactly the way it is presented today. How much can I expect to receive? That depends on a couple items. We'll go over that. And when should I apply for Social Security benefits? You know, that's a choice that's individualized for each of you out there. But we will talk about some basic rules of thumb and some definitions you should know before making that decision. Next slide. Next slide. So let's understand first and foremost the value of Social Security. Will that be there for me? Next slide. So here we go. Here's the trust fund. So OASDI Trust Fund, right? So what is OASDI? Old Age Survivor Disability Insurance Program. It's the foundation of Social Security, 1935, under the New Deal, Franklin Delano Roosevelt, essentially trying to solve the problem of widows that the pension would die off with at that time in the 30s, mostly husband that's off working. Pension would die off with the husband as he passed away, and then widows were left impoverished. So this was a part of the New Deal that allowed for there to be payments made to people that either didn't work their entire life or maybe worked a short time period before having children. And it became a safety net. And then we added Medicare, which I'll discuss next week as well, in 1965 under the HI program, the health insurance program. So just all the Social Security funds are held in what's called the Social Security Trust Fund, and the balance on December 31st of 2019, just under $3 trillion. You can see there 2.897, and this, of course, comes from the Office of the Chief Actuary for Social Security. In 2020, despite the pandemic and despite a crash in the markets and obviously significantly higher unemployment than this country's used to, double-digit employment numbers for most of the year, there was total income to the Social Security Trust Fund of $1.18 trillion in income. That means revenue brought in, and total expenditures was actually lower, 1.107 trillion in expenditures, for actually a net increase in the trust fund, despite what you may hear on mainstream media, of 10.9 billion to the trust fund, ending the trust fund just over 2.9 trillion for the year ended 12/31/20. I don't have the numbers for 21 right now. My guess is the trust fund increased significantly in 21 though, because usually when we have a good market, an equity market that is, and very low unemployment, there's more people paying into their Social Security taxes. Therefore, we have more income than expenditures in the program. Next slide. So what's the problem? The problem is, long-term projections without reform, benefits fall to about 79, 80% in 2034, which now is only about 12 years away. And this is largely because the baby boomers, previously the largest generation before the millennials, are moving through the pipeline now and are all beginning to collect on their Social Security benefits. Therefore, expenditures exceeding revenues, and therefore the trust fund begins to whittle down. Next slide. So here are a couple of the potential solutions of what it would take to restore the Social Security Trust Fund to solvency. A couple of the reform proposals being studied: increase the maximum earnings subject to Social Security tax. 2021, it was 142,800. It went up this year. I believe it's in the high 140s, like 148, 149. That literally has been raised every year. The question is more so, do we do what we do with Medicare? Medicare, you pay Medicare tax on an unlimited amount of your wages. With Social Security, it's capped, just under 150,000. After that, you don't pay any Social Security wage tax. So the reform is actually not just increasing the cap, but potentially removing the cap so higher earners are paying significantly more into the system. That also brings up the question of if they played significantly more into the system, should they then have a corresponding much larger benefit? So, some of the reform proposals, raise the normal retirement age, currently 66 for individuals born between 1943 and 1954, and 67 for the rest of us. And potentially down the road, millennials or Gen Z or generations to come after could see that all the way up to 70 as we live longer lives and we extend the amount of time that we're working or in the work environment, paying into the system. The third one here, lower benefit for future retirees, doesn't seem very palatable from a political standpoint. And why I say that is, if you're a politician and you want to not be reelected to office or never get elected to office, it seems like all you have to do is take the voting population, or the largest voting population out there, and tell them that you're going to cut their benefits in retirement. That's probably not very palatable for most politicians, and so I don't believe that's probably a legitimate solution. And then reduce the cost of living adjustment. Again, this is a proposal. There's been a proposal to change how we calculate the cost of living adjustment. It's currently determined by CPIW, which is a consumer price index for working individuals. The argument there is that most Social Security beneficiaries or people collecting Social Security are no longer working, and therefore that CPI measurement is not as appropriate for them as maybe chain CPI or a different form of CPI. Again, these are all just proposals to get the system back to solvency. At the end of the day, more likely than not, I think you'd probably see the first one. You'd see earnings, at a much higher level, subject to Social Security tax, essentially raising taxes again more to provide the benefits, if we want to continue to provide the benefits as they are. Next slide. And I will say, the bottom line for baby boomers here, your benefits are not likely to be affected by Social Security reform. The one thing is you could see taxation on Social Security rise right now, and we'll discuss this a little later, so you don't have to write it down, but 85% of your Social Security taxes at the federal level are taxed at ordinary income levels for most people based on income, provisional income. 15% is never taxed. You could see the entire amount subject to taxation, just like a dollar from your IRA or a dollar from a pension, but that is not the case as of now. All right, so next slide. Let's think of a clearer way to think about our Social Security benefit. Next slide. So it's inflation protected income. You've paid the premium in every paycheck, so be smart about how and when to collect. Next slide. So, and just to revisit real quick, the COLA in 2021 for this year's Social Security benefits is up 5.9%, which is a huge increase. Well, the COLA projected that they're going to announce in the middle of this month for 2022 to be added to Social Security benefits starting in January 2023 is projected to be somewhere between 8.5 and 9%. So one of the great things about Social Security is it provides this inflation protected income that other parts of potentially your investments or your pension plan, for example, does not keep up with as well. If you have monthly benefit $2,000 a day and you live, let's just call it 20 more years, you receive a total of $659,382 in lifetime benefits. So you can see real quickly, this for most of you will be anywhere from $500,000 to over $1 million benefit over your lifetime. Next slide. And that, if you look down at the bottom left, that is also assuming a 2.6% annual cost of living adjustment. As I just said, last year's living adjustment was more than twice that. And this year's cost of living adjustment is going to be potentially 3x that. So you can raise the amount of benefits that you're going to receive over your life significantly with those COLAs. If your monthly benefits $2,000 a day and annual cost of living adjustments are 2.6, you can see just in 20 years, that $2,000 today becomes $3,342. Again, inflation adjustments provide income that rises with the rate of inflation. Next slide. So how much can one expect to receive? Next slide. Well, it depends on two main things. How much you've earned over your working career and the age at which you apply for benefits. Now, it's really tough to go back and earn more money in the past. You can obviously still keep working and replace some of those lower income years with higher income years. But really the one you want to focus on is the age at which you apply for benefits. Next slide. So how the benefits are calculated, not super important to memorize or to understand, because this is what the Social Security Administration will do for you. This is what you get on your statement. But at age 62, each year's earnings are tallied up and indexed for inflation. And what's important here is that it's your highest 35 years of earnings, and that is what is used to calculate your benefit. A lot of people confuse that with 40 or 40 quarters. which is what you need to qualify for full Social Security and Part A with Medicare. But when it comes to Social Security, if you do not have a 35-year working history, let's say you've worked 30 years, then 5 of those years are calculated as zero earnings, and therefore it lowers your Social Security benefit, or at least you're not at the maximum. So one way easily to increase your Social Security benefit is to ensure that you have a 35-year earnings history where you've paid into a Social Security job for 35 years. Next slide. So here's just an example of the formula. You can see it takes these 3 different bend points and it multiplies them by a factor. The first factor 0.9, then 0.32, 0.15. The only important thing to really understand here is a lot of people don't think or understand that Social Security is means tested, and it absolutely is. This is how it is means tested, meaning that lower income folks actually get a larger proportional benefit for the amount they put into the system, okay? So, and it's because the bend points, right, the 0.9 is the first bend point, and then it goes to 0.32 for that next marginal amount of income, and then 0.15 for the last marginal amount of income. Therefore, a $30,000 earner marginally will get significant more Social Security benefit dollar for dollar than a $60,000 earner or a $90,000 earner. And that's how they set up Social Security to be means tested, or to protect those that are of lesser means or lesser income over their life. And that's what the system was meant to do, right? It's not a retirement plan, it's insurance, old age survivor disability insurance, right? So it was there to ensure that there was income for those that possibly don't have enough to save for on their own in their life. Next slide. Why shouldn't I claim early at 62 instead of delaying to 70? Well, here's where we're starting to get a little bit of strategy and understand the true value of Social Security. Next slide. So your monthly benefit is reduced if you claim early. It's called the actuarial reduction. It's also reduced for taxes and Medicare premiums, and benefits could be withheld if you work. That's called the earnings test, and it all depends on something called full retirement age. Next slide. So when should you apply for benefits? What are some things to think about? Next slide. Well, health status, certainly if you are under, have a health situation under duress and you have no means or you need the income, you need to apply early. You can't wait till later, right? But if you do have some means, some other sources of income, i.e. 403B, 457, pension, it certainly may be helpful to delay your Social Security benefit. I'll go over why here in a second. And whether or not you plan to work, because if you are going to work, you're going to have that thing called the earnings test, where they can take away your entire Social Security benefit if you have a certain amount of income, depending on what year you are, if you're in your year of full retirement age or prior to that. And then again, survivor needs. For those of you that have done a lot of financial planning and retirement savings, you always want to max out for the surviving spouse, because the higher income earner can provide a much larger benefit for that surviving spouse over their lifetime as well as their own. Next slide. So will it be enough to live on in retirement? Probably not. Just to give you some statistics, about 1/3 of this country, their only source of retirement income is Social Security. But for the majority of Americans, Social Security income equates for about roughly 1/3 of their retirement income. So it's certainly a bucket that you need to know and understand. Next slide. So this is a really important term to understand and know, full retirement age, right? It's the age at which you're no longer subject to the earnings test. And for those of you born 1943 to 54, it's 66. It stair steps up 2 months from there all the way to 1960. And in 1960 and later, the full retirement age is 67. Next slide. So what if you apply for early benefits? Well, you'll receive a percentage of your primary insurance amount. And just so you understand what primary insurance amount is, it's the amount of your Social Security benefit on your statement at your full retirement age or projected at full retirement age. So let's just take this. Let's take if your full retirement age is 66, you apply at 62, you can see there you're getting a 75% cut in your Social Security benefit, or excuse me, 25% cut of your Social Security benefit. So you only get 75% of what it says your primary insurance amount is. Whereas if you full retirement age is 67 and you apply at 62, you're taking a 30% haircut on your benefit. Next slide. Even more importantly, if you wait till after your full retirement age, you get these things called delayed retirement credits. That's an 8% annual increase in the amount of your Social Security, guaranteed by the full faith and clear United States government, added to your Social Security benefit. And here's the most important part, that a lot of people fail to recognize or understand. The cost of living adjustments are added each and every year to your Social Security benefit, even if you have not claimed it. Even if you've not claimed it, you get the cost of living adjustment. And then on top of that, if you are waiting past your full retirement age, and I'm going to use the right side here, 67. So your full retirement age, you get 100% of your benefit at 67. You can see it's 68, 108%, 116, 124. So at 70, you get 124 plus the cost of living adjustment. Well, I just said the cost of living adjustment for this year is going to be at a minimum 8.5%. Add that on top of 8. How many of you have a portfolio that's up 16.5% year to date? I'm guessing not a single person in the entire audience. And so it's important to understand this is a safety net for your retirement and your retirement income. And it's really important to understand the benefit of delaying Social Security, especially in times like we're in right now, where markets and qualified accounts are really struggling, right? This is the time to rely or understand why you maybe wait till 70 to maximize that Social Security benefit. You're getting an extra 24% guaranteed by the full faith and credit of the United States government at 67, right? I've already told you at the federal level that Social Security is tax advantage. At the state level or California level, California does not tax Social Security wages, okay? So it is 100% tax-free at California level, which is wonderful because that's completely the direct opposite of your pension or 8403B or 457 withdrawals, right? So it's real easy to see why $1 of Social Security benefit is worth significantly more than $1 of your pension from UCSD, if you have one, or your IRA, or your 403B, or your 457. And hopefully you can start seeing where I'm going here with this presentation, is to not only help you understand the value of a Social Security dollar, but how to really structure your retirement to make it more guaranteed, more tax efficient, and less subject to risk in the markets. And I'll finish the presentation here in about 20 minutes with using the whiteboard to show it visually so you have a little better understanding of how we structure in our business folks' retirements using their Social Security benefit. Next slide. So how do you get an estimate of your Social Security benefits? Well, you can change, it's just easiest to type in ssa.gov. You go to the little button that says estimate your retirement benefit, and you can click on any of it, and it'll give you that little piece of paper you used to get in the mail annually that we don't do anymore, unless you request it, that the Social Security Administration sends you that gives you estimates. Just remember the estimates that you get from Social Security do not include future cost of living adjustments. So all three of the numbers, 62 and let's say 67 and 70, all three of the numbers are actually incorrect. They're just estimates by Social Security because Social Security will not estimate a future cost of living adjustment. We have a program that helps our clients estimate a future Social Security benefit based on inflationary numbers, but the SSA.gov website nor actually going to Social Security Administration, they will not estimate those for you. Next slide. So why delay benefits? Well, you get bigger checks to start. Let's start down here at age 67. You get 100% of your primary insurance amount. Let's say your benefit was $2,800 with a COLA, it's $3,183. You can see up here at 62. This is kind of how your statement would look if you're 62 years old and you're looking at a Social Security statement. I'm looking at the third column right now, and it says 62, 1960, and 67, 2,800, and 70, 3472. That's what you would see on your Social Security statement. And you'd go, wow, that's great. I'm going to get 3472 when I start taking checks, but I have to wait till 70. And then you start calculating what that 1960 per month times 12 times 8 years, and you start trying to do this, draw this break even. But that's an incorrect assumption because it's not including a cost of living adjustment. And you can see in the bottom right there, if you add in a 2.6% annual cost of living adjustment from age 62, the statement should really read 1960 and then 3183, which would be 67, and 4263 at the bottom. You can see the bottom number, when you'd actually start Social Security at 70, it's no longer 3472. It's really 4263 because of the compounding of the cost of living adjustment. It's almost $1,000 more a month, or if you think of it from the standpoint of percentages, you're looking at a roughly 33% increase in the value of your monthly benefit in Social Security. That's a big difference, especially when you think about it being guaranteed by the full faith and credit of the United States government, being very tax advantaged at the federal level, tax-free at the California level. And again, backstopped by the government, the US government, unlike your pensions, and only backstopped by the California government. Next slide. Much bigger tax base is what I'm saying. Well, the United States with 340 million people versus California with 42 million people. So why delayed benefits? So more income later on because benefits at age 70. If you claim at 62, you can see your benefit there is 2407. If you claim at 70, it's 4263. Next slide. So how do we maximize our benefits? Next slide. Well, you examine your earnings record from the latest Social Security statement available online, again, ssa.gov. You got to go back and you have to actually look at each year and make sure it's accurate. Make sure that your employer, especially if you're looking at in the 1990s, 1980s, a lot of employers inaccurately reflect or inaccurately reported income. So you want to go back and make sure it's accurate. Are there any missing years? Or were the years that you were just completely left off, or the SSA did not calculate what your wages were in that particular year, particularly if you're a business owner? You definitely want to make sure that is correct. And can you improve it by working longer? As I stated earlier, it's your top 35 years of earnings. So you want to ensure that you have a strong working history. And if you continue to work and you're making more money, let's say now, significantly more money now than you did 25, 30 years ago, you're also going to be increasing your benefit based on the fact that you're getting further up in those bend points in the calculation of your benefit. Next slide. So, and then applying for Social Security at the optimal time. Consider your income needs now and in the future. Your life expectancy, that's a tough one, right? Because we don't know how long we're going to live. But there is some data out there, especially from some of these research. Fidelity did a study at one point that said that average health couple that gets to the age of 65, I believe, is a 50% chance that one of the two of them is going to live to be 90, and a 25% chance one of the two of them is going to live beyond 95. So you really need to think about your life expectancy, not just in the context of how long I'm going to live in my benefit, but also, what is the life expectancy of myself and my spouse together, especially if I'm the higher income earner, because I'm providing that benefit for my spouse as well through what we call a survivor benefit that we're going to discuss in advanced Social Security. Next slide. Let's talk real quick about the taxation of benefits. I mentioned it earlier. Next slide. So remember the annual earnings test that I mentioned. So if you apply for a Social Security benefit before full retirement age and you work, for every dollar benefits will be withheld for every 2 you earn over $17,640 in 2019. That number's a little old. It's closer to 20,000 now. But you can rapidly see if you have a full benefit and you're making 60,000 in wages a year, the reality is most of your benefit, if not all of it, will be taken away. Okay. It doesn't mean it stops growing. It will continue to grow because you continue to put it in the system, but they won't be giving you your Social Security benefit because it is technically supposed to be a retirement benefit. Don't let the annual earnings test discourage you from working, right? And to avoid the earnings test, wait until your full retirement age. Once you get to your full retirement age, and let's say it's 66 or 66 and 4 months or 67, then you can work as much as you want. You can make $50 million a year and you'll still get your full Social Security benefit. Next slide. So the taxation of benefits is based on something called provisional income, which you can see with a little star up there, and then the bottom, it's just your adjusted gross income plus 1/2 your Social Security benefit plus a tax-exempt interest, meaning including interest from municipal bonds. This provisional income formula was created in the early 1980s when wages were obviously significantly lower, and they were never indexed for inflation. So pretty much anyone that's married is falling in that over 44 at the bottom there, which means the amount of Social Security subject to tax is up to 85%. What does that mean? Does it mean you're getting taxed 85%? No, it just means 85% is at your ordinary income rate. You have to remember that's still 15 cents on every dollar that has zero taxation at the federal level. And as I said earlier, California does not tax Social Security income, and so it is 100% free from California income tax. Makes it very, very tax advantageous if you're a resident of the state of California. Next slide. So how do we minimize taxes on Social Security benefits, even though, as I said, it's a very tax efficient or tax advantageous form of income retirement? Well, you just reduce other income with tax advantage investments. This is mostly going to be deferred annuities, right? That you're not taking any income off. Anticipate IRA RMDs, which maybe put you in a higher tax bracket. Consider drawing down IRA before 72. I'm going to discuss that much further here in a second when I get to the whiteboard, because I think it's really important from a strategy standpoint when it gets to retirement. Converting traditional IRA to Roth, I'm not as big of a fan as this, even though it's in a slide, and that's because most of you, if not all of you, are California residents, and every dollar you convert from traditional to Roth IRA is ordinary income, and being in the most progressively taxed state in the union, it makes it much more difficult to effectively transition to Roth from a traditional IRA without incurring a significant tax liability. Delaying Social Security, I like that one, reduce the number of years benefits are subject to tax. Reduce your expenses and then continue to manage taxes throughout retirement, capturing gains and losses in your non-qualified accounts as you go along, especially in years like this year. Next slide. Just remember also that your Medicare benefits come out of your Social Security check. If you take the majority of my advice and you do wait to 70, you're going to have to set up your Medicare premiums to come from outside your Social Security check. But once you do start Social Security, they're automatically deducted. Next slide. So here are the key points to remember when applying for Social Security. If you apply early, remember your benefits start lower, they stay lower for the rest of your life, less affect the compounding COLA has on them. COLAs magnify the impact of early or delayed claiming. The longer you live, the more beneficial it is to delay benefits. Remember that your benefits will be taxed and reduced to cover your Medicare premiums, and don't let the earnings test discourage you from working, and delaying benefits may give you your spouse more income. Because survivorship can be up to 100% of the primary income earner's benefit after they pass away, depending on when the survivor claims. Next slide. So if I'm not going to live long, so why should I just claim my benefits while I can? Next slide. Well, for couples, you remember you should always maximize the higher earnings benefit to protect the surviving spouse. Again, this is starting to get into what we're going to discuss more in the next presentation. So I'm going to move to the whiteboard here shortly. But one rule of thumb that we can always go to the bank with when it comes to Social Security is the higher earning spouse should try to maximize their benefit by waiting to 70 for many reasons, and I'll go over all those in the next presentation. Next slide. Real quick, just so you guys understand or have and I'll review this again in the next presentation as well, what spousal benefits are. The spousal benefit is half the primary worker's primary insurance amount started at full retirement age. So here's an example. John's primary insurance amount is $2,000 and Jane's is $800. If Jane applies at her full retirement age, her benefit would go from $800 to $1,000. She doesn't get both. She gets the higher of the two because it's 50% of John's primary insurance amount. But she has to wait to full retirement age to get half of John's PIA. And there's no reason to delay after full retirement age to claim spousal benefits because they don't increase by the delayed retirement credits like your primary benefit does. Next slide. So here are the rules for spousal benefits. The primary worker must have filed for benefits. So you can't claim spousal if somebody has not claimed on their own benefit. The spouse must be at least 62 for a reduced benefit. If you claim early on spousal benefits, that will also be reduced. And like I just said, there's no delayed credits on spousal benefits. So the maximized spousal benefit is when you reach your full retirement age. Next slide. All right. So this is where I stop for Social Security 1. I've thrown a lot at you already. I gave you several different terms. If you could give me control of the board here, I'd like to go to the whiteboard real quick and just kind of try to bring or encapsulate everything together about the benefit of Social Security and help you understand how valuable it can be in your retirement. All right. Hopefully everybody can see that. So let's just talk about a UCSD retirement here. And we'll just do a sample. We'll just do Jane Triton here, right? And these buckets here, or squares, or whatever you want to call them, let's just say these are different sources of retirement income. And I apologize for my handwriting ahead of time. I am definitely not an artist. All right, so let's make this participatory. So let's go, I'm gonna try to bring up the chat here. Or if you just want to unmute yourself so I don't have to try to do the chat at the same time, let's go over some sources of retirement income if you're retiring from ECSD. Anyone want to share with me one source of retirement income? Not all at once. Anyone?
Military pension?
Okay, let's just call it a pension in general. I like that. Military pension, or let's say we could say UCSD pension, but let's just lump them all together in a pension bucket here. What's another source of retirement income? If I have to, I'll start calling on people. This was always easier when I was doing this in person, because now I'm trying to flip through all of you on the, Gloria, you just happen to be at the top of my, what's another source of retirement income? You may have to unmute yourself there.
403B.
Yes, perfect, great. 403B, let's call it 403, right? B, gosh, that's a really bad zero, sorry about that. We could also say 457, right? We have that. For those of you in the civilian workforce, like myself, maybe a 401k. And then all of these things can be summarized, maybe in retirement, you move it over to an individual retirement account, right? All right, thank you, Gloria, that was great. Anyone else? How about what we're talking about today? Let's do that. So, I don't want that. I just got off my pen somehow here. Sorry, folks, 1 second. I'm obviously not the most accomplished Zoom person here. See if that works. Huh. Well, does anyone know how to get back to this to regular pen? Somehow I clicked off of it. I think it's text. Huh. Oh, there we go. All right, found it. All right, so we have Social Security. Oh, great, now this is good. Oh, this is great. I have a vanishing pen, but I can't find my regular pen. Does anybody know where I could possibly find this? No? All right, so I'll just point to the rest of these. So let's say this is Social Security, and then let's say we got maybe some real estate income, and we have a trust account over here, and let's call the trust account a just a savings account or a brokerage account of somehow, something like that. Okay, and so all these different sources, and this is going to disappear on me, but all these sources of income come down here, and they create what we like to call mailbox money, right? And that's what your monthly income down here that I was writing on, that monthly income becomes your actual retirement income. So all these different sources, the pension, right? When you take money out of your pension, it's taxed at what we call ordinary income, meaning you spend full, or you get taxed fully at the federal and state level on your pension income. Well, your IRA 403, 457, you take everything out, it is also ordinary income, all right? Now remember, this box is going to disappear on my Social Security, but remember what I said about Social Security. At the federal level, right, it's only 85 cents on the dollar, and in California, right, it's zero. Okay, so this income is extremely tax advantaged, whereas this is not, and this is not. Okay, I said real estate income, let's say you have a rental property or something like that. How is that real estate income taxed? Guess what? It's ordinary income. Yes, you get some depreciation and other things. And then finally, if you have a trust account or some type of brokerage account, yeah, you may have some dividend income or some tax advantage income. But remember, in California, there's no such thing as dividend income. There's no such thing as long-term capital gains income. California taxes everything as ordinary income. So yeah, it might be slightly advantageous at the federal level, but at the state level, not so much. So that makes this source, which is supposed to say Social Security, the #1 source of retirement income from a tax advantage standpoint, unless, of course, you have a Roth. The problem with a Roth, right, is that you had to contribute to it your entire life, and the limits have always been, $6,000, $7,000 and below. So it really is not a big bucket as compared to this or this, or even this in your retirement. So what am I telling you? Okay, if you can delay Social Security past 70, okay, and draw down on these assets that are subject to investment fees, investment expenses, expense ratios, whether you work with a financial advisor or someone like myself or not, right? All of these investments have hidden fees and expenses that you may or may not know, or, you know, fees and expenses that are disclosed because you're getting help or this and the other. Yeah, your pension is all ordinary income, but that doesn't have the cost of living that Social Security does, all right? I don't remember the exact facets around the pension at UCSD. We're actually going to discuss that later this month in the IIG. But I believe for the first 2%, you get it lockstep, and then for each % after that, or excuse me, for each 1% of inflation after that, I believe you only get 0.25%. Okay, so that if you have a 6% inflation rate, you only get a 3% increase in the pension. Whereas with COLA, or excuse me, Social Security, your COLA would be 6% or just about the exact same, even possibly higher, because it's based off of CPI, right? CPI is going to disappear on me, W, okay? So from the standpoint of a pension versus Social Security, pension is taxed at ordinary income in California. Social Security is not, which makes it much better. And the COLA is much better, okay? I've already explained to you how Social Security is worth significantly more than these assets, okay? So why not early in your retirement while you're 60s, if you retire at 62, 63, 64, 65, why not draw down on this, which is subject to market risk, fees and expenses? Even if you're in Fidelity and you manage it all yourself, you still have expense ratios, you still have mutual funds that you have to invest in, right? And so everybody's kind of got a little tiny hand in your pocket. Social Security, what's the expense ratio of Social Security, right? It's 0. And it's guaranteed by the full faith and credit of the United States government. As I said, from 67 to 70, you have delayed retirement credits, and you're going to get an 8% increase in the value plus the COLA, all right? If somebody could guarantee you 8% plus a COLA and these investments every year for 3 years in retirement, wouldn't that be a great deal? Well, you do get that guarantee here. So why not in your 60s draw down your risk assets that are subject to fee and expenses and that have risk associated with them and all kinds of other great things in the market, and allow this investment or this guaranteed pension grow substantially in the 60s, and then you switch from this at 70, because you still won't be at RMDs, turn that off, and you maximize your Social Security, and now you're in a much more tax advantageous spot. You have less risk in your portfolio because you're more dependent on guaranteed sources than you are on all these other variable sources. And that is the crux of my argument when it comes to the benefit of Social Security. And I'll stop the share here and go back to just my face, is what people do not understand is that Social Security not only provides you more tax advantageous income in retirement and a guaranteed 100% survivorship for surviving spouse if claimed at the proper time, but also a cost of living adjustment that actually matches the true rate of inflation, okay? And a pension you cannot outlive, guaranteed by the 340 million Americans that are out there, or at least however many of them are still working. So the value of Social Security to someone in retirement is significantly more than just a paycheck, because it can reduce risk in your portfolio, reduce fees and expenses in your portfolio, and put more guarantees at the exact time in your life when you need and want guarantees, because you don't need market risk in your late 70s and 80s and 90s when you don't have all that time to make up for years like this year when it's down 25% in the S&P 500. And with that, I'll conclude, and I will take a couple of the questions over here. I see Tony D. Let's start with your question here. I'm a single man currently collecting Social Security. Good, and I'm glad you're collecting, because you said no. By the way, there's no reason any of you should ever wait beyond 70 to collect Social Security. There's no reason whatsoever to wait a day past 70. I am contemplating marrying my 15-year female partner, who is 67 years old. I believe that I predeceased her and we were married for at least 9 months, and that my wife could be able to collect my Social Security benefit as my monthly Social Security is higher than hers. I've reached out to Social Security to ask if she would receive what full retirement age benefit inflated by Social goals. or she would get the amount I currently receive, which is higher because I deferred beginning to 69. I've called Social Security twice and have received conflicting answers. So I only have an answer for you. So if you're married for more than the 9 months, okay, there is an exception to that. If it's by accident of some kind, then the 9-month waiting period is not required. But you are correct, because she is above her full retirement age and your benefit is greater than hers, she can collect your survivor benefit, which would be 100% of your benefit at her full retirement age. So the correct answer, as long as it's 9 months after marriage, Tony, she would collect 100% of your benefit. And then John Thomas says, Social Security Roth try to escape. I assume, I'm assuming you're saying do a Roth conversion, escape California to do that. Sure, you could move to Nevada, and then at least you won't have to pay state income tax on the conversion from traditional IRA to Roth IRA. Somehow I think it'd be more expensive to move to a new state, though, than it would to be to pay taxes on the conversion. So that is certainly one of the big issues. Any other questions before I wrap it up? It's 12:45. I invite all of you to come back to Advanced Social Security in a week and a half here, where I'll go over some specific claiming strategies, but I will remain here in the chat for the next couple of minutes in case anyone has a question, or Vanya or whoever's running the slides, if you want to bring up the first slide that has my number and my, thank you, John, as always. If you want to, has my email information, you can certainly email me any questions you may have. There's my email address, website on the website, or you can email. We also have Social Security estimators, which is just a little form you fill out, whether you're single or married, or you have a significant other, however you want to put it. And we, for UCSD Retirement and Emeriti Association only, we do a free complimentary Social Security analysis to show you how to maximize your Social Security benefit. Again, that's by emailing me at the email address or going straight to the website and downloading the forms off the website, and be happy to provide you the analysis. We have several people on the team that do it for our clients as well. So with that being said, I don't think I see anything. Oh, there's one more in the chat. Thank you, Patty. I appreciate it. Thank you, everyone, for joining me today. It's always great to be part of UCSD, and I hope to see each and every one of you on a follow-on presentation. Have a great Tuesday.